Good afternoon. Welcome to the FIIG Securities Constructing a Balanced Fixed Income Portfolio. My name is Elizabeth Moran. I'm Director of Education and Research here at FIIG. Today I have Ryan Poth, my colleague, joining me. Ryan is Head of FIIG's Portfolio Strategies and has over 27 years experience in fixed income. Prior to joining FIIG, he spent 8 years as a fixed income proprietary trader at UBS and Cargill in Singapore. He relocated to Brisbane in 2000, where he worked as a fixed income quantitative analyst for Queensland Investment Corporation for 4 years. He joined FIIG in 2005 and has been involved in many facets of the business, ranging from portfolio management to the development of the financial models used in pricing fixed income instruments. And for those of you that have ever looked at the maths behind bonds, it's quite complicated, and Ryan has a very mathematical, quantitative-based mind, and we welcome him today. Thank you very much for joining us, Ryan.
Thank you, Liz.
Just before we get underway, a little bit of housekeeping. On the right-hand side of your screen, you should be able to see a panel. Now, if you can't see the panel, there's an orange arrow there. Can you click on that, and the panel will display. Down that right-hand column, you'll see a section for questions. And if you have any questions during the presentation, please send them in to us. We love getting questions. And we'll both attempt to answer the questions as we go through. But we have a large number of people on the line today, so if we don't get to your question, we'll try to get to it after the presentation. But without further ado, I'd like to hand over to Ryan, and thank you very much for joining us this afternoon.
Thank you, Liz. Good afternoon, and thank you for joining us today. My name is Ryan Poth, and I am leading a new team at FIIG here at FIIG Portfolio Strategies. Our aim in Portfolio Strategies is to work with you to maximize value from your portfolios. And what we want to do to achieve this is to help construct new portfolios, performing regular portfolio reviews, the goal being to make sure your portfolios are continually optimized for current economic conditions, regularly communicating current offers and opportunities, including new issues as they come along, sending out market and security-specific news and research in a timely fashion as it arrives, producing articles on overall portfolio strategies, and by acting as a point of contact for all portfolio and transactional requirements. Today's presentation will focus on the various factors that we use when constructing new portfolios and reviewing existing portfolios. It's important to mention that FIIG are licensed to provide general advice only. Investors need to overlay this with their own personal circumstances when looking at their investment portfolios. There really is no one-size-fits-all model for fixed income portfolios. This means that you'll have to do some of the groundwork yourselves, but we can work together to combine your personal requirements with our fixed income insight and create the optimum portfolio for your desired outcome. Before looking at specific securities to include in a portfolio, there are a few decisions that you as the investor will have to make. Once these decisions are made, then constructing the portfolio is really a matter of selecting the best value securities in the market to meet those goals while maintaining a good balance. Proper balance is important because it serves to minimize extraneous risks to your portfolio's performance. The first question to ask is, what portion of your portfolio should you allocate to cash and fixed income? This is often answered by asking the inverse question, what portion of your portfolio are you willing to risk in order to achieve higher capital growth? That portion can be allocated to riskier assets, such as equity or property, and the remainder is your defensive allocation, which is cash and fixed income. Within the cash and fixed income allocation, investors should also ask themselves how much they want to keep in cash for upcoming commitments or to take advantage of potential investment opportunities as they arise. The allocation of cash and fixed income really is an element that varies widely between investors. The popular guideline is to invest your age in cash and fixed income. What this means is that if you're 40 years old, you should maintain 40% of your investment portfolio in cash and fixed income. If you're 60 years old, that allocation rises to 60%. The rationale behind that mantra is that the older you are, the lower your ability to recover from a financial shock, such as we experienced during the GFC. Younger people have more income producing years left before retirement to recover. From a personal perspective, I'm 53 years old, and I tend to keep between 50 and 60% in cash and fixed income. So you could say that I'm practicing what I preach. Once you've decided your allocation of fixed income, the next question to ask is, what is your fixed income risk appetite? Well, fixed income is the defensive portion of the portfolio, but risk within that asset class can vary from very safe cash equivalent securities, such as short-dated bank and government debt, to securities with yields and risks closer to equities, such as hybrids. An optimally balanced fixed income portfolio is not merely invested at one end or the other of that spectrum, but in a variety of securities in between, each selected on the basis of relative value to their peers. Determining your fixed income risk appetite will also help you decide how far you want to stray from a balanced portfolio in order to implement your market views and potentially enhance your returns. Another important decision to make is how much cash flow do you require from your fixed income investments. This is particularly important for individuals in pension mode and relying on that income to fund their lifestyle. Some securities pay low ongoing income with a portion of the investment yield incorporated into the value of the returned principal at maturity. Others pay higher income but may have a diminishing principal value. The difference can be witnessed under two sets of circumstances. The first is to do with securities bought at a discount or premium to their face value. When a bond is issued, there's generally a coupon rate that is paid on that bond, but as interest rates rise and fall, the yield on the bond may change along with those rates. If the yield on the bond is lower than the coupon rate, it follows that the investor will have to pay a premium in price terms for that bond. Conversely, if the yield is higher than the coupon rate, the bond is purchased at a discount. Bonds purchased at a discount will pay lower ongoing cash flow and have a higher principal repayment at maturity. Those bought at a premium will have higher ongoing cash flow and a lower principal repayment at maturity.
So Ryan, like in today's market, that in essence means that bonds trading at a discount are under $100 and those trading at a premium are over $100, and there's quite a lot trading over $100 now, isn't there?
That's correct. Generally, the par value on a bond is $100, so if the yield is over the coupon rate, it is less than 100, and if the yield is below the coupon rate, it is greater than 100. And you have to remember that many of these bonds were issued 5, 6, 7 years ago when interest rates were much higher, so they have higher coupons and lower yields. Therefore, you will be paying a premium for these bonds. So the second situation where there's a trade-off between income and principal is related to the two types of inflation-linked bonds. But I'm going to cover that in more detail later in the presentation. Identifying your income requirements will help determine which securities are best choices to give the appropriate balance of ongoing cash flow and appreciation of the principal value. The next step to take is to formulate a view on the direction interest rates, inflation, and general credit risk premiums may take over the medium term. It's okay to build a balanced portfolio that will perform consistently throughout all market conditions, and there's nothing wrong with that. But a few further decisions and regularly realigning your portfolio accordingly could potentially double the returns achieved. The main factor to consider in fixed income is the expected duration interest rates and inflation may take over the medium term. Market conditions have changed dramatically since last year, and the only certainty is that they'll continue to change over time. Last year we had a steady cash rate at 2.5% and a relatively steep yield curve, which means longer-term rates were much higher than the 2.5% cash rate. You can see this in the chart on the bottom of this slide, where the light blue line is where the swap curve was a year ago, and after a year they start to increase dramatically. This implied that market expectations were that the economy was on the brink of a recovery. Many fixed income investors took the opportunity to buy long-dated fixed coupon bonds and inflation-linked products, and they did very well out of that decision. This month we've had the Reserve Bank start to nudge interest rates lower to 2.25%, and the yield curve has dropped significantly, making the value in longer dated bonds more difficult to justify. You can see in this chart the dotted gray line is the current swap curve, and it's clear that the longer term rates have dropped significantly and are not that much higher than the cash rate. Consensus view is that interest rates will remain low, though, and even move lower for a longer period of time than was forecast last year. If that's proven to be correct, the strategy of remaining in longer-term bonds could well continue to outperform this year. Furthermore, inflation is sitting at the lower end of the 2 to 3% band, but the RBA has indicated in its latest policy statement that they remain comfortable that it will remain within that band. This implies that it's their view that inflation should pick up over the course of the year. In terms of credit or corporate bond risk, general credit premiums continue to be cheap in Australia compared to the US and European counterparts. In Australia, the average 5-year investment-grade corporate bond premium, which we measure by using the commonly used iTraxx bond index, is 95 basis points, whereas the comparable premiums in the US and European indices are closer to 60 basis points. For reference, a basis point is 1/100th of a percent, so that 95 basis points is 0.95%. The Australian index does typically trade at a wider margin to the US equivalent, but the premium over the European index seems unjustified, particularly given the current problems in that part of the world. Another theme playing out in the market currently is the turmoil in the mining and oil sectors. This is causing bonds issued in those sectors to cheapen significantly, which can be viewed as a risk or an opportunity, depending on your longer-term view on the survivability of companies in that sector. Capturing these changes by continually positioning your portfolio accordingly is what can make the difference between achieving the yield at which you constructed your portfolio and achieving a return that is potentially much higher.
Ron, we've got a number of questions really regarding inflation-linked bonds, one from Tanya and Han, and sorry, I can't remember the third person, can't see the third person's name here on the screen now, but they're wondering if you're concerned about deflation, like would you still buy inflation-linked bonds? And Han asked specifically, with our house view of lower interest rates for longer, consistent with low growth and lower inflation outlook, you know, why would you buy inflation-linked bonds?
Well, inflation-linked bonds are an interesting diversifier for a portfolio. I've found in my experience that there's reasons to buy them in a rising interest rate environment and reasons to buy them in a lowering interest rate environment. The reason behind this is that if inflation is falling, and certainly if it's expected to even go negative, you can almost guarantee that the long-term interest rates will fall. What that means is that the yield, the real yield or the margin over that inflation rate that these bonds attract will fall as well. And that means that the market valuation of these securities will rise. So if you do have falling inflation, you're also going to have falling long-term interest rates, and the value of that security, that long-dated inflation-linked bond, will rise, and you could take a capital gain on that. The other side of that equation is that if rates are going up, and which will suffer the market value of that security, rates will only go up if inflation is going up, and inflation going up will increase the income you receive on those bonds. So there's a common question: when's the right time, and when isn't the right time to buy inflation-linked bonds? And I honestly believe there is no right or wrong time. They just make a good diversifier in your portfolio.
Okay, I've got another question which I might answer, and this is from Edward. He would like us to explain the graph a little more on the slide. So, as Ryan said, the light blue line was the swap curve a year ago. So what a swap curve is basically when the banks, they're indifferent between taking a fixed or floating rate of interest. So the curve, and it goes out a long time, they swap interest rates over a very long forward time. So you can actually plot all those different expectations and you get this line. So in essence, it's like a proxy for where they think interest rates are going to be in the future. So the light blue line shows a swap curve as at the 1st of January 2014. The darker blue line, and you can see it's moved down considerably, shows the swap curve as at the end of December 2014. So expectations over that year of forward interest rates have come down considerably. Now, you'll see there's another line there, and it's the grey dotted line, and that's actually the swap curve the afternoon after the RBA rate cut just last week. And you'll see that whole curve has moved down again, so that if you're looking at the bottom line, the tenor, so that's the 3 months, 4 months, and you'll see the Y stand for years. So right at the end of the x-axis, if you like, 15 years, and you go up from that, that grey dotted line is sitting under 3%. So that tells us that interest rates are going to be much lower for much longer, and that really, if you're waiting, to try and, hoping term deposit rates are going to come up, you could be waiting a very long time. And of course, you're speaking to a bond, or you're listening to a bond broker. Our suggestion is you think about buying bonds. But that's enough for me, and We'll continue with Ryan's presentation, and we'll try and answer a few more questions as we go along.
Thank you, Liz. Oops. Apologies for that. I'm a bit mixed up in my slides here. So these here on this slide are the considerations we focus on when analyzing fixed income portfolios, both when constructing new portfolios and when reviewing existing portfolios. Company or credit risk on a whole of portfolio basis refers not only to the risk in individual credits, but rather maintaining an overall balance across all parts of the risk spectrum. This is primarily a matter of maintaining balance across highly rated investment-grade securities and lower-rated securities, including sub-investment grade and unrated bonds. Now, we are prohibited by ASIC from discussing specific credit ratings with retail investors, so I'm going to limit my discussion here to investment grade and sub-investment grade. But for wholesale investors, the analysis can become much more granular than that. Capital structure refers to where the security sits in the worst-case scenario should the company go into liquidation, which is important because this defines the priority of payments that they must make to the creditors. On a most basic level, we look at the balance between senior debt and subordinated debt, and as the names imply, the former is paid out before the latter in a liquidation scenario. Industry diversity can be an important consideration when there's a disruptive market event, such as the GFC, or more recently, the mining sector collapse, during which entire sectors can be affected, taking the good along with the bad. Issuer diversity is more or less self-explanatory. Just as you wouldn't invest your equity portfolio in a single stock, you wouldn't want to invest your entire fixed income portfolio in a single bond. Selecting a mix of bond types, or income or coupon types, is an important consideration to get the right balance of income and capital preservation. But it's also important to maximize potential returns for where we are in the economic cycle. Finally, there's some general considerations that may apply to some portfolios, which we'll cover, and of course there will be considerations related to each individual security that need to be taken into account. Now, I know this slide could look a bit busy, but it's very useful because it shows much of the criteria we use in analyzing a fixed income portfolio in a single snapshot. The charts along the bottom of the page demonstrate 4 of the major portfolio balances we analyze, which are, going from left to right, the bond types or income types the securities provide, the credit risk, be it investment grade or versus sub-investment grade, the capital structure, senior, subordinated debt, hybrid securities, and industry diversity. The detailed table above shows the issuer diversity, but also gives details regarding prices and yields that the individual bonds were purchased at, which is useful to visualize the relative value achieved. Going from left to right, the first column is the face value of the holding in each security, followed by the security description, which has some very useful information, including the coupon rate and the maturity or call date. The bond type, which is the coupon type or income type, which is going to be either fixed rate, floating rate, inflation-linked, or inflation-linked annuity. The place on the capital structure, senior, subordinated, or hybrid, the sector to which that security belongs, the cost price and capital value paid for that security, the portfolio weight, which is the percentage weighting in the entire portfolio of that single security, and the annual yield to call or yield to maturity at which that bond was purchased, and the income yield, which is the income portion of that yield to maturity. The small table at the top right-hand side of the page shows some summary values for the portfolio, including the total capital value invested, the weighted average portfolio yield, which is your expected return if you held the entire portfolio to maturity, the income portion of that yield, and the weighted average term to maturity of the portfolio. I would like to point out here that the portfolio here has been constructed with actual securities in the market, available in the market now, but does not necessarily represent a recommended portfolio. I've constructed this sample portfolio specifically to demonstrate the portfolio balance aspects of this presentation.
Ryan, we have a question from Elizabeth who's asking how many sectors should you diversify into?
Well, I'll discuss that a bit further when I go into the sectors specifically, but it's not necessarily a matter of the number of sectors, but you want to make sure that you're not too overweight in any one sector that has a tendency to be risky or volatile. And certainly included in that would be, very topically, the mining sector, but also the other sector we look at in terms of concentration risk is the finance and insurance sectors, because those were the ones that were initially hit the hardest in the GFC.
The other question we have, Ryan, I'll just ask one quick question. A couple of listeners have asked about foreign currency bonds and the US dollar dropping, and our view whether we think there's more currency gain on those US dollar bonds, or should you rely on the income from those bonds?
Well, that's an interesting question, and it is something that I will cover later in the presentation, although in much more brevity than I guess that question was asked. But I guess we're not foreign exchange advisors, and we don't. I guess everybody's view on the foreign currency is different. I know that quite a few people here and elsewhere think that the currency has a potential to fall to 70, even 65 cents to the U.S. dollar. This is really a call that you have to make yourself. And act accordingly. I think if you do think that they're going to fall, then obviously you can enhance returns immensely from the foreign currency movements. But it's a bit of a danger to think that you're going to use the bond yield as an investment on its own right when you've got currency risk, because the currency risk and the returns you could make out of the currency could potentially be much greater than the yield on the bond.
Okay, just two other questions while we're on this slide, because I think this slide's a fairly important one. And just to reiterate that this is just a sample. This isn't Ryan's recommendations here. But we have a question from Stephen wanting to, can you explain what the yield to call is versus the maturity versus the income? Those percentages are in those columns.
Yes, and I'll touch on this a bit later, but in brief, the yield to maturity or the yield to call, if there is a call date on the bond, it's yield to call, otherwise it's yield to maturity, is the expected internal rate of return that you're going to make on that holding, on that investment from now until that maturity date or call date. The income yield is the actual ongoing income portion, and the reason that those are different is that because you could buy a security at a discount or a premium, if you buy it at a discount, then part of your yield to maturity is going to be the capital gain you get from holding that bond to maturity, and the other part is going to be the income. If you buy it at a premium, you'll have income and you'll have a capital loss on the bond technically as the price goes down from wherever you bought it to 100, generally 100 upon maturity of the bond. So the income is only part of the equation. The income yield, or running yield as we often call it, is only part of the equation. If you want a good picture of what you're going to make, what your expected total return is on the bond you would tend to look at yield to call. However, income is quite important for some people, particularly people in pension mode on their self-managed super funds that are relying on that income to fund their lifestyle.
Okay, just one last question from Bernard asking how important is the diversification shown in the sample portfolio? He has just 5 bonds of a similar total value. Would you like to comment on that?
Yes. If they're all of a relatively high quality or you're comfortable with the names, I generally, and again this is this is a topic I will touch on, I generally consider 25%, more than 25% of a portfolio to be overweight in a safe security, or what you would personally consider a safe security, and probably go down to about 10 to 15 max if you're looking at some of the riskier securities. So technically you could hit that 25% max if you've got 4 different very safe securities. You could build a perfectly fine portfolio of 4 different securities. If they're all sub-investment grade or hybrids or towards that riskier end of the spectrum, you'd want to be a bit more diverse. I tend to like to see people take no more than 15% of their portfolio in some of those assets. So moving along, the first measure of balance that we generally inspect in portfolios is in terms of credit grade. For wholesale investors, we can break down and analyze security ratings in portfolios in greater detail, but the key aspect we're looking for here is the balance between investment grade and sub-investment grade or unrated securities. Sub-investment grade tend to be categorized as speculative, but can enhance the yield on the portfolio, and choosing the right ones can achieve the right risk-reward balance, just as choosing the right stocks can achieve the same balance for an equity portfolio. It's also worth mentioning that some unrated securities do not carry credit ratings for purely economic reasons. If the size of the issue is small and the issuer is comfortable that they can distribute the desired volume without a credit rating, they may simply choose to do so without bearing the cost of having that security rated. As a basic rule, I look for a minimum of 60 to 70% investment-grade securities as representing a conservative balance. Investors often include more or less. We see some portfolios with virtually no investment-grade securities, but they're very diverse portfolios, and investors have done their homework. So investors could include more or less, depending on the amount of research they're willing to conduct themselves and the comfort that they have in the individual bonds. Because of the greater onus of investors to perform their own due diligence in analyzing sub-investment-grade securities, it naturally follows that diversity is more important for that portion of the portfolio. As you can see in this portfolio, the high-yield portion is invested across a broader range of smaller investments to maintain that diversity.
I've got a couple of questions, Ryan. One was asking about the credit ratings and why we didn't show them on the previous sample bond portfolio. And I just want to say that we're not allowed to show credit ratings to retail investors. So by law, we can't show you. We would like to. We think it's a crazy situation we're in. But if you can qualify as a wholesale investor, we can show you. So if you're interested after the presentation, still want to know the credit rating of those securities, let us know and we can send them to you if you're a wholesale investor. We had 2 very good questions from Tim, and he's saying, is the 20% of that portfolio, the previous page, overweight by security or issuer? For example, Commonwealth government bonds are plus 40% of an index, but in a spread of issues across the curve.
Sure.
So in other words, Tim, my view is that it would be by the issuer. So we wouldn't want to see, for example, more than 25% of a portfolio by Sydney Airport, if you like. And Sydney Airport has 2 inflation-linked bonds, so you might have a combination of those making up your 25%.
That's right. That's right. It's not necessarily by security, but it is by issuer, because you have 2 securities issued by the same issuer. You have double the risk to that issuer.
And just one last question from Gary. Hello, Gary. Hope you're well today. He's asking what credit rating qualifies as investment risk. So credit ratings that are we usually quote the Standard & Poor's rating scale. BBB minus and above is in investment grade, and that goes up through single A, double A, triple A, and then BB plus and lower is non-investment grade. So that goes double B, a single B, and C's and D's, and there's all pluses and minuses there. So it's quite a big scale, Gary. But I'll pass back over to Ryan and let him continue with the presentation.
Thank you, Liz. In addition to the credit grade considerations, we have the placement and capital structure of the investments to consider. Knowing where a security sits in the priority of payments in a liquidation scenario is really important to fully understand the risk associated with that investment. On the right-hand side here, we see a graphic representation of where different types of securities issued by a company are graded from lowest to highest risk. The lowest being the senior secured debt, most of which is owed by the company to their banking partners, but can also be issued in securities such as covered bonds. And the highest risk in this graphic is at the bottom is the equity ownership in the company itself. In the middle sits the securities that we normally deal in, term deposits and unsecured bonds issued by the company. The bond types here cascade from senior unsecured, which is the most common type of bond issued, down to subordinated debt and then through to hybrids. As a basic rule, same basic sort of rule I use for credit grades, I look for a minimum of 60 to 70% in senior debt to represent a balanced portfolio. With larger allocations of subordinated debt, greater diversity is important, just as it is with credit grades, as is a smaller allocation to the riskier hybrid debt. There's also a very important aspect of capital structure that bears discussing. In late 2003, financial institutions began changing the terms of their subordinated debt to comply with the new Basel III capital adequacy requirements. These new securities contain non-viability clauses that can force the securities to be converted to equity or written off completely in a distressed situation, which puts their risk very much closer to equity risk. These clauses can apply to both subordinated debt, lower Tier 2, and additional Tier 1 hybrids, which are also known as contingent convertibles or COCOs. That is not to say that these securities should be avoided altogether, but it's important for investors to know which type of subordinated debt they're buying, old style or new style, and make sure if you are buying the new style that you're well compensated for the additional risk undertaken. Diversity across industry sectors is an element that can be important in some industries and less so in others. I touched on this a bit earlier in answer to the question, one of the questions. One of the most important sectors to look for concentration risk is in the financial sectors, including insurance. Stress to individual issuers in these sectors has a tendency to pull the entire sector down, as we saw in the GFC, dragging the good along with the bad. Some of the sectors are less affected by concentration risk. I generally make allowances for the infrastructure sector because that has a tendency to experience much lower levels of volatility in times of stress. I also tend to make some allowances for the corporate sector as it's very broadly defined. However, it's important to look within the corporate sector and try and identify some more specific sector concentration that can lead to unwanted volatility, such as we're currently experiencing in the mining and oil sectors.
Okay, I've got a few questions, Ryan, some really fantastic questions coming in, and I don't think there's any chance we're going to get to all of them, but I'm going to try and group some. Quite a few people have been asking about the hybrids, and would you have an allocation to hybrids? And again, Alan's asked, most advisors warn against hybrids, yet most of them are oversubscribed, and he's wondering why.
Well, as I think I kind of indicated, is hybrid risk is very much closer to equity risk than fixed income risk. But to say you should never buy hybrids would imply that you're saying you should never buy equities, and I don't think any of us are going to do that. Hybrids, just like equities, will have the right time and price to buy them and the wrong time and price to buy them. And I can say at the moment there are well-priced hybrid securities and they're horrifically expensive hybrid securities. You just have to analyze each one independently and know which ones to buy and which ones to avoid. And I'd also say that if you're looking at hybrids as part of your fixed income portfolio, make that a smaller portion. If you're looking at them in terms of equities and putting them in terms of your equity portfolio, I would almost argue that you could make them a larger portion because they are slightly less risky than the equities.
A couple of interesting questions here about the capital structure from David and Max. David's asking, how can you compare the capital structure between issuers of bonds? And that's pretty tough. You can. What you actually have to do is go to their annual accounts and look, and the annual account should specify what debt those companies have on their balance sheets. So, for example, a lot of the smaller companies have bank debt, and that's secured over assets of the company. So that would be senior secured debt as such. And if there was a bond, if that same company had issued a senior unsecured bond, it would sit below that debt. And of course, you should be able to have a look at the shares and where they're trading on the ASX and get a value in terms of the equity value of the company. Max is saying that senior unsecured debt is not always graded by Standard & Poor's. That's true. Not all companies have credit ratings. Some just don't need credit ratings, and to have your debt assigned a rating, companies have to pay for that. So companies that are fairly assured or have some confidence that they're going to be able to issue a bond without a rating, of course that's the optimal thing to do because it's cheaper.
That's right. It can be quite expensive. And also some companies, if they think they're on the borderline of being able to get a bond issued without the rating, and they don't think they're going to have a high enough rating to do it credit, then they won't bother to get it issued either, get the rating issued either.
And just one other last question from Peter. He's asking about how do you tell which bonds are convertible. He says convertible, and I'm assuming they're converting to shares. They're mostly hybrids, but there are also some sub-debt under those new rules. So that's one of the questions that you would ask your broker if you wanted to buy hybrids, bonds or investments. Are these investments, can they be converted to shares?
And that's very important when we're talking about convertibility, it's very important to differentiate between convertibility at the investor's option or convertibility at the issuer's option. Because obviously if it's convertibility at your option, you don't have to convert it. But if it's convertibility at the issuer's option, or in the case of COCOs, it's not even the issuer's options, it's the regulator's option. If they deem them unviable, then those are the ones that bear the higher risk. So the next issue is issuer diversity. And unless the portfolio consists entirely of very high quality names, it's important to maintain diversity across individual issuers. As I think I previously stated, I generally consider anything greater than 25% to be excessively large for most securities, with smaller limitations made for riskier securities. As such, a portfolio can be constructed with as few as 4 securities and still maintain a reasonable level of issuer diversity, so long as they're relatively secure. There's a greater importance to maintain higher levels of diversity in riskier securities, in particular if there are any other risk factors we've discussed so far. It can, however, be a bad habit to attempt to maintain an overly diverse portfolio if the securities themselves don't exhibit excessive risk in their own right. With diversity comes the responsibility to keep on top of the risk metrics of each security and issuer. This can be time-consuming and unnecessary if all the securities are very high quality. We can see in this portfolio here that there are large allocations to the less risky assets, which are the top 4, and that the riskier portion is well diversified across 8 distinct and unrelated issuers. The Preco index annuity bond at the bottom of the page is a small allocation for an entirely different reason, which I will cover later. The next factor to consider is the type of income generated by these securities. There are 4 basic types of fixed income securities commonly issued. They're fixed coupon bonds, which pay a regular fixed rate of interest, floating rate bonds, which pay a marginal rate over the changing short-term benchmark rate, usually the 3-month BBSW rate, bank bill swap rate. Capital index bonds, which is a type of inflation-linked bond which pays a rate of interest based on a principal value that is constantly growing in line with the rate of inflation, or CPI. And index annuity bonds, which are another inflation-linked product that pay interest over the same increasing principal value, but have the principal amortizing over time. So in other words, each quarter, the remaining value of the principal indexes up with inflation and then pays down a portion to eventually end up with no principal value remaining at maturity. Choosing the right mix of bond types is important for 2 reasons. Firstly, the level of ongoing income or running yield can be significantly different between different bond types, even for bonds with equivalent risk. The total yield to maturity, or yield to call, as I mentioned before, is made up of 2 parts: the income yield, or running yield, as is also known, and the increase or decrease in the value of the principal. As we discussed, this is true for bonds bought at a premium or discount, but is also pertinent for capital index bonds, which I'll discuss shortly. Choosing the right mix of bonds is also important. Choosing the right mix of bond types, I guess, is also important to express your view, if you have one, on the current economic, interest rate, and inflation environment. For example, in the current environment of low interest rates and relatively shallow yield curve, you may want to limit your exposure to longer dated fixed coupon bonds. If the economy were to pick up from here, those longer term yields would rise, which would have an adverse effect on the valuation of longer-term fixed-coupon bonds. Somewhat ironically, this is particularly important for safer credits such as government bonds, where there is little or no credit component to the yield in these securities, so they will be most directly impacted by a steepening of the yield curve, whereas longer-dated securities with a credit component, such as corporate bonds, have that credit component in their yield, so the yield is partly the rate to the maturity, but partially the credit premium for owning that corporate bond. And any steepening of the yield curve is usually offset by tightening of the margins that the premiums that you pay for, or that the issuer pays, I should say, for issuing their corporate debt. Floating rate bonds provide pretty tepid income at the moment, but that income has a potential of improving if interest rates rise. And the impact of changing interest rates to market valuation on these bonds is virtually negligible, making them much less volatile in a rising interest rate environment. Inflation-linked bonds are good diversifiers because they contain traits of fixed and floating rate bonds. They have a fixed rate component, which is the coupon tied to the security, and an inflation-linked component, which is the increasing principal value. And as I said in answer to the question earlier, in a low inflation environment, longer-term interest rates will be coming down, which should increase the value of that security in the market. And in a rising interest rate environment, yes, you will get a deterioration of the market value of that instrument, but you will also be getting higher income in the form of CPI.
A couple of questions, Ryan. One from David, which I think is excellent. Having established a modest portfolio, to what extent does liquidity become an issue? And is active management and switching in and out of the underlying bonds often required and readily achieved?
Well, liquidity is an issue if you think that you're going to need the funds before maturity. So if you do think that you're going to need the funds before maturity, yes, you should stick to securities that have a high degree of liquidity. And liquidity differs bond to bond, and certainly your representative or your advisor could tell you or give you some sort of idea which ones are more liquid than others. In terms of switching opportunities, now you don't have to switch your portfolio around. You don't have to switch around at all, but there are opportunities that come around that make switching your portfolio around very advantageous and can greatly enhance the yields or the returns you make on that portfolio. We did a piece last year where we looked at the average returns that people made on their bond portfolios if they held the entire thing to maturity, and compared that to the yields, to the returns that they made, the investors made, who actively managed and altered their portfolios on a regular basis, and the difference was more than 2 to 1. They're more than double the returns off of people who actively manage their portfolios. But that's not to say that you have to do that. That's an option. So at this point, I'd like to digress slightly to discuss a topic specific to inflation-linked bonds that is often overlooked. As discussed, there's 2 types of inflation-linked bonds common in the market, and they both have their advantages and disadvantages. Capital index bonds, or CIBs, have low ongoing cash flow because much of the value in the yield is in the increasing value of the principal, keeping in mind that the principal increases over time along with the CPI rate. So these may not suit investors that are relying on ongoing income. Indexed annuity bonds, on the other hand, or IABs, pay out a portion of the principal each quarter according to a predetermined amortization schedule. And as such, they exhibit much greater ongoing cash flow, but they have no value left at maturity in the principal. So they may not suit investors who are, or they don't suit investors who are interested in capital preservation. However, in the right proportions, these 2 security types can be combined to normalize the cash flow and principal value features and provide a mini portfolio that looks very much like a normal bond with similar investment and maturing values and cash flows that are linked to inflation. In this combination, the low CIB cash flow is combined with the high CIB cash flow to provide a normalized cash flow. And the increasing value of the CIB principal is combined with the diminishing value of the IAB principal to result in a stable principal value. If desired, this has the added value of giving the investors the ability to precisely target their cash flow and principal protection needs by simply adjusting the proportional face values of the separate investments. So in the sample portfolio, I've done exactly that. I've taken a 90,000 face value investment in Sydney Airport 2020 Capital Index Bond and combined it with a 20,000 face value investment in the Preco 2020 Indexed Annuity Bond. In these proportions, my total invested value was around $138,000, and so was the maturing value in the principal, which is the maturing value of the Sydney Airport Capital Index Bond. The income I received based on a 2.5 assumed inflation rate over the long term starts at 4.92% and increases each quarter along with inflation to end up in 2020 at 5.54%. So it looks much more like a normal bond with a rate of income tied to inflation. An additional point worth observing is that there's an important difference between this inflation-linked bond combination and a floating rate note. With a floating rate note, the level of interest paid can increase or decrease as interest rates rise and fall. But with this inflation-linked bond combination, the implied interest rate you receive will always rise as long as inflation is positive. That's an important differentiation. There's one final note I'd like to make regarding indexed annuity bonds. A common response I hear over and over again from younger investors is that they do not suit, as a higher income is not necessary. Sometimes that high cash flow can be useful if you believe that the investment market, be it fixed income or equities or property or wherever you're investing, is not showing you good enough value, and you'd like to park cash somewhere and have it come back regularly and take advantage of opportunities as they arise. This is particularly true of shorter-dated indexed annuity bonds and is arguably quite pertinent in the current low interest rate environment.
I think too a lot of those bonds that are issued are very high credit quality. So a lot of our investors, even though they don't want that income, are attracted to the returns and the very low risk nature of the bonds. But a couple of other questions regarding inflation-linked bonds, Ryan. David asks, do you have to hold a capital index bond to maturity to realise capital gain through inflation?
No, you do not, because the market is well aware of what the current indexed face value is, And whenever you go and seek to sell that in the market, a fair price you should seek to achieve takes into account the inflated value of the principal from the time it was issued until now. Conversely, when you go and buy one of these in the market, you will have to pay that inflated index face value as well. And if you go back and look at the sample portfolio and look at the top bond, the Sydney Airport bond, you'll see a very good example of this, where the capital price on that bond was 139, but I think the index face value is right around that 139. It's 137, I think, at the moment.
It's very close, isn't it?
So the current face value of that bond is well over 100, and you would get that if you went and sell the bond in the market. You don't have to wait till maturity.
Okay, and Chris asks, what happens to inflation-linked bonds in a deflationary cycle?
In a deflationary cycle, they do not. The value of the principal does not drop, but it does not start increasing again until inflation at least reaches that high water mark where it started to go into a deflationary cycle.
And just one last one. Denzel asks about the tax implications of inflation-linked bonds. We're not actually allowed to talk about tax, Denzel. It's a very good question, but if you get hold of a copy of our Australian Guide to Fixed Income, there is a whole tax chapter in there written by the PricewaterhouseCoopers, and it explains it in there. So if you want to give your dealer a call, or perhaps we can send it to you. But I'll carry on now. There's some very good questions coming in, but they're more, I think I'll hold them off till the end of the presentation. I'll let Ryan finish.
Thank you, Liz. So now we come to some other miscellaneous considerations to watch for that may apply to some portfolios. And the first one is currency risk. Over the past 4 or 5 months, the volume of non-Australian dollar bonds our clients have purchased has grown significantly. It is important to recognize that if the investment was made as a speculation that the Aussie dollar will fall in value, that is a major risk-reward proposition, and the returns on the bonds themselves can potentially pale in significance compared to the gains or losses made on the currency. Another risk to watch for is the structural risk in mortgage-backed securities. Some of these securities can offer extremely good returns, but the securities are in various tranches in a broad spectrum of low to high risk, and it's very important for investors to familiarize themselves with what to look for when analyzing them. I would suggest a good place to start would be to register for one of FIIG's RMBS courses. They're very good, and if you're interested, please ask your FIIG representative for more information. I also look for call risk in individual securities. Now, some securities have call dates in addition to their maturity dates, where the issuer has the right but not the obligation to redeem the security at a specific price at that time, usually but not always $100. There's 2 ways the market looks at yield when quoting callable bonds. Most subordinated debt issued by financial institutions have call dates that the market assumes will be triggered. It's extremely rare that these bonds are not called, and investors for the most part assume that they will be called, so yields are generally quoted to that call date. There is a risk, albeit minor, that the security will not be called, and if investors were counting on those funds being returned at that time, they would have to sell the security in the market in order to access those funds. Another risk to callable securities, not often discussed, is for corporate bonds that are priced to the maturity dates but have call dates embedded. It's generally unknown whether the issuer will call those securities until very close to the call date, and they are often quoted as a yield to maturity. But if they are called, the yield to call date could be potentially much lower. Even at a lower yield, though, that does not necessarily make them a bad investment. Take, for example, a P&P finance bond. The current price of $105.90. The implied yield to maturity date in October 2017 is an attractive 6.32%. However, the security is callable in October this year at a price of $103. If the bond is redeemed at that time, the implied yield to the investor will be a much lower 4.29%. This is much lower than the expected yield if not called, but I would suggest that 4.29% is still quite an attractive return for an 8-month investment in the current environment. In these cases, some investors tend to look at these securities as fair value short-term investments with a yield kicker should the security not be called. Final and most granular piece of analysis to look at is looking at individual securities, looking for the specific risks associated with the bond or the issuer, and also looking at relative value against peer investments. Some example of the items we look for are the call risk that we just discussed, the refinance risk, which is risk that upon maturity of the bond, the issuer may experience difficulty refinancing that debt and therefore may not be able to pay that debt out. Regulatory risk, which covers issues such as the COCO risk, the contingent convertible risk we previously discussed. Strife or turmoil associated with the industry or specific issuer. The obvious example here is in the mining sector, but another converse good example is the Qantas downgrade out of investment grade realm that happened in December 2013. When this occurred, the price on Qantas debt plummeted, and investors quick to recognize this as an opportunity have since realized in excess of a 10% internal rate of return on that investment to date. Relative value within the same issuer is another security-specific aspect we look at. Some issuers have multiple bonds available, such as most financial issuers, but also a few corporates like Qantas and Sydney Airports. It's important to recognize which one of these represents the better value and select the right one. There are also occasional opportunities around this where we've seen investors take advantage by switching between the relevant bonds. Personally, I've seen some investors switch back and forth between the Sydney Airport 2020 and 2030 bonds several times and increase their returns way over that they would have achieved by simply remaining in the one bond. Relative value against other similar credits is another aspect we look at. We look at a bond and gauge who are its peers to identify where investors can increase returns by switching from one to another. One example I'll give here, there's many I could mention, but one example is a comparison of Dalrymple Bay Coal Terminal with Adani Abbott Point Coal Terminal. The latter is trading currently about 40 to 60 basis points cheaper, mostly due to adverse attention that Adani is experiencing.
So Ron, that 40 to 60 basis points, for those of you that don't know about basis points, 1% equals 100 basis points. So 60 basis points is 0.6%, which is quite a lot in this low interest rate environment.
That's right. The last aspect I wanted to mention was upcoming maturities. It's a minor part of the consideration, but it's very important to keep on top of upcoming redemptions because they can easily fly under the radar and get missed, which means these funds could be sitting in a cash account, sitting idle in a cash account when they could have been reinvested immediately upon redemption and continue working for you. So thank you for your time this afternoon. I'd like to finish off this presentation by summarizing the top tips to help investors self-assess their portfolio. Your FIIG representative can also assist with this assessment, but it's useful for you to have this at hand as well. So firstly, assess the risk in your portfolio. Do you have a good balance of investment grade and sub-investment grade securities? Do you have a good balance of senior debt and subordinated debt? Does your portfolio have sufficient diversity amongst industries and amongst issuers? Does it have too much unnecessary diversity? Is your portfolio balanced according to your current view on interest rates and inflation? Are there any other risks in your portfolio? And if so, are you comfortable with those risks? Secondly, assess the returns. If you are taking any risks above, or the risks that we mentioned in the last slide, are you getting paid enough for those risks? Are you getting the right balance of income and capital preservation? And can you improve your returns or lower your risk without sacrificing returns by making any adjustments to your portfolio? So where do you go from here? Well, if you haven't invested yet and would like to start looking at building a portfolio of fixed income investments, I would suggest you register on our website to receive our weekly newsletter, which has some very good ongoing information about the market. open an account, which you can also do online or by calling us, and contact a FIIG representative to help you go through what it takes to construct a portfolio that suits your needs. If you're an existing fixed income investor and have a portfolio already, but haven't reviewed that portfolio recently, have a closer look at it with a fresh approach. Consider what may have changed in the market since you last reviewed your portfolio. Consult with your FIIG representative to discuss whether there are any alterations that make sense. And do this on a regular basis. I normally suggest that most investors try and do this on a quarterly basis, but it's up to you as to how frequently you want to do it. But you should do it regularly.
We have lots of questions, Ryan. The question is for me, where do we begin? Okay, I'm going to start with Keith and Wayne. They had a question quite a while ago about what defines a retail or a wholesale investor. And I'll answer this one just to give Ryan a little bit of a break. So all investors are classified as retail unless they can prove their wholesale. And to prove that your wholesale, you need to have an accountant or a third party state that you have earned more than $250,000 gross for the last 2 years, or that you have net assets of over $2.5 million. Of course, depending where you live, if you live in Sydney, I think you probably easily jump that $2.5 million value on your property prices that seem to be doing very well down there. Not quite so for us up here in Brisbane. The next question, we've had some really excellent questions. One from Roger that I'm going to hand back to Ryan. Roger asks, can you give us a concrete example of rebalancing your portfolio and how that increased the client's return?
Yes, I can, on a very simplistic basis. At one stage, the client was invested entirely in medium-dated and short-dated floating rate notes at one stage last year, and he switched into a combination of longer-term inflation-linked products and medium-term, and when I say medium-term, I mean 5 to 6 year fixed coupon bonds. So that 5 to 6 year gave them the fixed coupon exposure without going too long, so increasing the risk too much, and it also gave him a credit component because he switched into some of those were some of our unrated or sub-investment grade securities which were paying high yields, and the very long-dated inflation-linked bonds which have done enormously well. And he switched from a portfolio of floating rate notes that were maturing in 2016, which would have done nothing but travel along, earning tepid income and doing very little, to he would have capitalized probably greater than a 10 or 11% return in the last year doing this.
Fantastic, that's great. Now we had a question from Eileen before the presentation started actually, so thank you for that, Eileen. We like those questions. What is the minimum investment for a portfolio, she asks, and she also asks, can we please discuss the mix available for retail investors?
Well, the minimum amount for a fixed income portfolio, if you execute it through us, is $50,000. You can buy individual bonds for as little as $10,000 face value, but we do require a portfolio to have at least $50,000 to start you off. And in terms of the mix of available bonds for retail, there are quite a broad variety of bonds available for retail, much more so for wholesale if you can get that certificate. But there are a fair amount of retail bonds available across the entire spectrum of fixed, floating, and inflation-linked bonds.
We have a question from Sven, who, another really good question, asks some benchmarks on what constitutes reasonable return versus risk. So it's very hard, Sven, in a market where rates have been declining to work out what risk return is appropriate. But one of the things between investment and non-investment grade, so that BBB minus to the non-investment grade, which typically that's where you're going to, take a sort of a leap in risk, if you like. So the Qantas bonds, which are sub-investment grade, and the 2020s are paying about 5.3%. So that's we call that pretty well high yield at this point because it's non-investment grade. So high yield of about 5.3%, and less than that, Adani Abbott Point is paying, and I can't remember. Ryan, do you know off the top of your head?
It is. I can't remember off the top of my head, but it's in the mid-5s.
Yeah. Okay. So that's high. It's paying
high
higher
yield.
It's one of the
Adani Abbott Point is one of the highest yielding investment grade fixed coupon bonds in the market today, and that's all down to the media exposure that they're experiencing.
So clearly, if you have confidence in Adani Abbott Point, that might be one that you would look to invest in, but that's a wholesale-only bond. A couple of other questions we've got from John. He's saying, you know, it seems like you need a lot of money to invest across different issuers, and if you had only 100,000, would that be better to invest in a managed fund? Managed funds, I've looked at quite a number of them, and they do have greater diversification, unquestionably they do, but the problem is that you don't know what they've invested in, and the ones I've looked at will only give you their top 10 investments, and typically that makes up about 50% of their portfolio. So roughly you're giving your money and handing it over to fund managers who take control. They decide when to pay interest, and you lose that natural interest payment date and also the natural maturity when you invest in a managed fund, because you're then subjected to a unit price. So there's quite a lot of difference between the two. I think if you're keen and willing to learn more, having your own portfolio and being able to control when you buy and sell, and take suggestions from someone like Ryan as when to sell and when to buy different bonds, certainly we would think you could outperform a managed bond fund.
I would think so, and we certainly have plenty of people with $50,000 to $100,000 portfolios. And the other advantage is that not only do you know what you're investing in, but you decide what you're investing in. Obviously, we can help you do the research and help you pick the securities that are best value, but ultimately you have the final say of what you invest in, and you don't with a managed fund.
No, exactly right. We always get the question about fees at FIIG, and we've had a few people ask about fees. So we're a broker, and we take a brokerage fee, and that fee is in essence the difference between where we buy the bond and where we sell it, and it's typically small. The rates of return we show you, though, in a constructed portfolio are what you would expect to earn. So those fees are already taken into account. Now, we don't trade unless both the buyer and the seller are happy with the amounts we offer them. So, and Michael just has asked, in relation to the wholesale retail thing again, how do we decide when a bond is just for wholesale only?
Well, there's a number of reasons a number of factors that go into whether a security is available to the retail market. The primary one is the security has to be seasoned, and what seasoned means in this respect is that it has to have been trading in the market for a year before we can offer it to retail clients. That's the most general categorization of what we can do for retail investors. There are some securities that specifically say in the documentation that they are for wholesale investors only, and in fact some of them say that we're not allowed to sell them to trusts. So we have to look at the documentation closely in each security to determine what we can and cannot sell to retail investors. And obviously, if we can sell to retail investors, we make effort to make it available to retail investors.
Got a very good question here from Sandra. Sandra asks, what percentages of your total bond allocation should go to the different types of bonds, including US dollar bonds?
Well, it depends what you mean by different types of bonds, and certainly I can easily answer the US dollar bonds, and that's a matter of how much you want to risk in the view on the US dollar versus Australian dollar. I would view a US dollar bond as more of a speculative investment than a conservative fixed income investment. I know there's some that would disagree, but because of the volatility of the FX rate, you have to be willing to commit a higher amount of risk to that trade. You will undoubtedly be expecting to be rewarded much greater for taking that view. And if the currency does what the market generally expects it to do, and that is to fall to 70 or even 65 cents on the dollar, you will do much better out of that. But you are taking on more risk, so it should be a smaller allocation. In terms of other bond types, I'm thinking if you're talking about fixed, floating, and inflation linked, then we look at a normal standard balanced portfolio as having a third of each, and then we work around those. And we tend to at the moment have, well, last year we tended to have more fixed than floating, and at the moment we probably have equal fixed and floating with a bias towards inflation linked.
Okay, got a very good question from Guy. An interesting question and one that I haven't come across before. And he says regarding age allocation, he's seen arguments elsewhere that 100 minus the age should be changed to 120 minus the age due to enhanced longevity rates. We're living longer and we need greater capital to sustain longer retirement. Would we care to comment?
I certainly haven't heard that before, but the rationale kind of makes sense, except for if you're 101, I'm not sure what you do.
I think you're pretty happy if you're 101 and you're still got all your faculties. I'd be very happy with that.
But the reality is that in Australia, investors have a woefully small amount invested in fixed income. So whether it's 120 minus your age or whether it's 100 minus your age, they both make sense, and I guess you use your own judgment which measure you use. But I would argue that most people probably have much less than that currently.
I think so too. And one last question. This is the last one. We're going to wrap up after this question. And I'm delighted to hear from Charles, who is possibly a younger investor. And he's asked, would bonds be appropriate for him? He's looking to buy a house in 3 to 12 months' time. And would that be an appropriate investment for that time span?
Well, I would say if you're definitely looking to buy a house in that time, yes, bonds could be a good investment. I would say if you look for a bond that matures in that time span, that's your ideal investment. And if you can get better than a term deposit rate, that's what you should look for. Otherwise, you could look at very liquid bonds that you have a high degree of certainty that you will be able to sell fairly easily in the market when it comes time and you need the money. There's a broad range of very liquid bonds available. But you have to be willing to take the risk, though. If you buy a fixed coupon bond and interest rates rise, if you long-dated fixed coupon bond and interest rates rise over the next year, you're going to be selling that bond for a loss. So that may not be your best option. So in general, I would probably recommend you stick to a shorter-dated bond in that case.
Fantastic. I just want to thank you, Ryan, for a very insightful presentation. It's got all of us thinking. We've had some fantastic questions. We haven't been able to get to all of you. We will certainly send those people that requested copies of our guide or certain chapters, we will send those out to you. We will also make the presentation available after we finish today, so you can listen to it and see the slides again. I'll just reiterate that Ryan he's looking after people's portfolios and making suggestions to them. So if you have a question or would like your portfolio reviewed, that's the service that we're going to provide to you. But once again, thank you for joining us, and Ryan, thank you so much for your time and insights today.
Thank you for inviting me.
That now concludes the presentation. Thanks again. We look forward to delivering further presentations in future. Good afternoon.